Hello and welcome to Macro Mondays. I'm James Todd, Direct Trader here at Onyx Commodities, standing in for James Brodie, who's away this week.
And I'm Will Cunliffe, a research analyst here at Onyx Capital Group.
So, as always, this week we'll be going through some of the key market data, charts and risk that we like this week. We'll be discussing the Trump tariffs and the turmoil on the back of this. And we'll also be looking at how sovereign yields have been doing over the past week or so.
We'll also be discussing hedge funds having had a strong bounce back in Q2 after a weak Q1. And we'll be diving into the US housing market and looking at some more concerning indicators there. We'll look at how this may play out in the week ahead as well.
So yeah, first major bit of news for the week was to do with the US court ruling that Trump's tariffs were unlawful. So the US Court of International Trade said that Trump had misused his emergency economic powers and that his executive orders went beyond what any president was allowed to do. This, of course, sent shockwaves throughout a number of asset classes almost immediately. And, you know, ultimately we're seeing now the US Court of International Trade and Trump are absolute loggerheads.
Yeah, they're really kind of, I mean, it was no surprise really that the White House was moving to overturn the ruling. And in fact, you know, Trump came out over the weekend and slapped an extra 25% on steel and aluminium tariffs, so that they're now up to 50%. So he's clearly not too concerned about the ruling. And even Goldman Sachs came out and said, you know, this is only a temporary setback to his trade agenda. And, you know, there's plenty of other tools at his disposal that can be used to continue to implement tariffs. And I mean, the market did react pretty strongly. I think a good asset that captures this is the 2-year break even here. So that's effectively market's pricing of inflation expectations over the next 2 years. And you can see, you know, there's quite a big move down when those initial US-China tariffs were moderated for the 90-day period. And then we got another sell-off in the break-evens after the ruling. So, you know, the market was taking the ruling seriously. And yeah, obviously lower tariffs will lead to low expected inflation.
Yeah, so it's an interesting one. And of course, there are all sorts of impacts, including, as the chart here highlights on the 2-year break-evens, the inflation expectations. But one of the things that, you know, is just from a very basic level is clear is that none of this, you know, it's clear as mud what is actually going on with tariffs, etc. And, you know, the fact that this Court of International Trade is saying that he's sort of breaching his executive powers, I could see this being something that sort of is a common theme throughout much of his presidency, not just relating to trade, but to a number of things, perhaps even the possibility of a running for a third session as president. But yeah, the fact that perhaps it even took this long for the Court of International Trade to say that this is, you know, offsides, this is illegal, is almost a bit surprising to my mind.
Yeah, and then, you know, they gave him like a pause on the ruling, at least when they were moving to overturn, and when the White House was moving to overturn the ruling. So yeah, we'll see what happens there.
But, you know, on the back of this, obviously there was the 2-year break-even move, but we've also seen the 10-year yield. That's been quite jumpy over the past week, hasn't it?
Yeah. Well, the nominal yield is of course constructed with the real yield as well as the inflation expectation. So the inflation expectation coming off naturally should imply a lower nominal yield, and that's kind of what we've seen here. So you can see on the 29th of May, when we saw that fall in 2-year break-evens and that further down the curve as well, 10-year yields are coming off. And, you know, this has been a pretty contentious point for markets is, you know, is the US debt sustainable? And are markets currently pricing that level of risk? You know, credit default swaps on treasuries have been roofing. They're now pricing higher than credit default swaps on CGBs, on Chinese government bonds, as we discussed a couple of weeks ago, and they still are now. And this has been causing a lot of like hedge funds were very short treasuries for quite a long time. We knew of like Paul Tudor Jones back in December targeting 4.5% yields when it was far lower, and targeting 5% even. And asset managers have recently started chopping net length in Treasury futures in the week ending 27th of May, according to the CFTC data. And the most aggressive unwind has been in the more deferred tenors. Hedge funds who were already short have also been forced to cover those short positions, as there's not been that huge break down. And the biggest short unwind there has been at the ultra long tenors. So, once that covering has kind of happened, we might even see further moves to the downside.
Yeah.
There's so much issuance, and there's going to have to be increasing issuance now that if we do expect tariff pressure to start to subside and Trump's tax cuts come in, where is that fiscal revenue going to come from? They're going to have to issue, and probably more so now than before, which is going to weigh on the Treasury market.
Absolutely. And as you say, as the sort of supply inevitably is seen to be increasing, but also as you have this component part of it, the inflation expectations coming off, if this is to be the case and we are not going to be in a tariff environment, so the alternative, it's clearly pointing one way. And seeing market positioning on it is, of course, particularly interesting. And if hedge funds are having to sort of cover their shorts, it does add to some of the depth of the conversation.
Yeah.
But it does look as though it's, in this scenario of fewer tariffs, no tariffs, it does point to one direction, doesn't it?
Yeah, definitely.
And moving on. So not only looking at hedge funds and asset managers, but banks, we've been seeing that they are, in a very worrying state regarding unrealized losses. So realized losses, of course, being sort of things that are either positions that are exited or, taken profit on. What we're seeing here is you've found this very nice chart about non-marked to market securities that are basically going to be weighing very heavily on balance sheets for major banks.
Exactly. So within the income statement, securities are classified in two key categories. One is a held to maturity security and one is an available for sale security. Held to maturity basically means that the manager has said that they intend to keep that security until it matures. So if the market price of that security falls much lower, as long as you hold it to maturity, you never would actually realize that loss. The difficulty becomes when, let's say, we have a rapid tightening in credit conditions, or something, or there's a
run on the banks.
We struggle with liquidity. When banks look to liquidate that capital buffer, which is largely consisting of treasuries, they will realize a huge loss at that point, and that's when things can really start to unravel quite quickly. And it is just striking, after 2022, that huge accumulation of unrealized losses. And I think this is something that people aren't necessarily talking about too much. A lot of people will say, well, it's fine if you hold it to maturity, but there may be a situation where you can't.
Absolutely. And I don't think that's sort of hyperbole to be sort of speaking in those terms. We saw Credit Suisse, obviously recently, having these exact issues with, ultimately the reason that it had to be sort of taken over by UBS was not because of the actual liquidity, but it was because of fears about the liquidity.
Exactly.
And so you can have these, I suppose it's sort of similar in some way. Yeah, the runs on the banks and the liquidity crises can have really tangible impacts on the banks. And then, at that point, it just becomes,
for sure,
potentially hysteric, and you can see herd mentality having a dominating effect.
Yeah, and in the meantime, even when we might not have a run on the banks or a liquidity crisis just yet, banks will be increasingly more risk averse in terms of their ability to issue credit and their propensity to issue credit, really, which can obviously weigh on the on the credit market in the US. We might see banks issuing a higher interest rate, which will kind of undermine a lot of Trump's goals there.
Absolutely,
from
and
an interest rate perspective.
even on the personal side, you can find mortgages.
Yep.
That has an obvious domino effect upon the housing market, etc. So this is really important, and it's a good one to flag, I think. And then just tying everything together a bit with inflation expectations having perhaps eased a bit, but the general economic picture in the US not looking too bad at the moment. We've been seeing some OIS predictions changing.
Yeah, so I mean, last month was a huge turn in the OIS pricing of Fed cuts by the end of this year. We started the month at over 100 bips priced by year end. We're now around 50 bips, so that's 2 cuts priced. And I mean that does make sense, really. Like the labour market has remained pretty robust. We await non-farm payrolls on Friday, but the unemployment rate is pretty stable at 4.2%. There's been nothing too concerning in the weekly unemployment insurance claims reports, and at the same time, inflation is softening, and a PCE headline printed plus 0.1% month on month in April, at 2.1% year on year, so kind of slap bang on target. There's not really any reason for the Fed to be in a hurry here. And it's quite a stark contrast from last FOMC, where Citi, I think, were expecting 125 bips of cuts by year end. We're in a very different a very different landscape now and a very different outlook.
I suppose the only question remains is how much influence will Trump be able to cast over them? And, if things carry on as they do, and, it seems as though Powell and his crew are very, acting very independently, I'm not sure we are going to be seeing as aggressive cutting. But those questions, of course, will still remain.
I mean, he met Trump for the first time last week, I think, and Powell basically reiterated that any decision making at the Fed will be determined by the Fed.
Yeah,
and by the Fed's interpretation of that data. And given the data at the moment, I think it makes sense for the Fed to be on hold for now.
No, fantastic. And then moving on to US consumer confidence as well. So we've been seeing, performance in the S&P has been to the upside, and that's driving what seems to be a new wave of optimism amongst US consumers.
Yeah, I mean, it's quite an interesting one, because we had this big divergence between kind of the soft data and the hard data. And everyone thought at some point, that has to converge.
Yeah.
But I don't think this is quite how people expected it to happen. I think, the US Conference Board consumer confidence printed at 98 flat in May. That's far ahead of the 85.7 in April, and a big upward surprise, with markets expecting 87. I think most people had expected that soft data to kind of lead the hard data, and the hard data to come down at some point. Mm-hmm. But we're actually seeing the reverse here, which, like you pointed out, I think is largely a function of the performance in the stock market. But I mean, some of these stats are pretty crazy. The consumer expectations gauge increased by the most since 2011. It was the biggest jump in headline consumer confidence in 4 years. And but yeah, I mean, it wasn't all good. I mean, however, twice as many respondents in the Conference Board survey were more bullish on the stock market than their own job prospects. So I think that really kind of shows you what's driving the headline.
It's slightly bizarre overall, I would say. And consumer confidence, it's an important metric to look at, but it is ultimately a very qualitative piece of data, and it's not necessarily the framing of questions predispose people to answer in certain ways, etc. So whilst the correlation between consumer confidence and the S&P performance might appear to be back here, and the two are going in the same upward trajectory. As you say, I think it's the S&P that's leading people to assume that they might be able to have more of their investments are going to be sort of worth more, and so they can spend some of that money. And I don't see the bottom line, payroll data being particularly supported. And even, we saw a big miss on Friday with new home sales in the US. So that's very much, should be something that is married to consumer confidence. And so we've still got that divergence there.
That dislocation, yeah. And I think, it will be interesting to see how this plays out, because naturally there will be a wealth effect involved. Like if your 401k has just made 10%, then you're probably going to be a little bit more outgoing with your spending. We didn't necessarily see on the downside of that, when the stock market really got hammered, a reduction in consumer spending. So I mean, will we see some sort of non-linear relationship here where the wealth effect is supportive, or will we see consumers again just become more optimistic but not actually change their spending habits? It'll be interesting to see. But yeah, the housing market, as you say, is going to be a key focus moving forward, I think.
Yeah, and so moving just on from the US quickly to Japan. So obviously we've seen some huge moves in the carry trade and the USD yen move. But if we're looking more specifically at the Japanese government bonds, so last week we said, the Japanese government bonds had pretty much just been having a sole purchaser, and it's a slightly worrying situation overall.
Yeah, I mean, it's historically the BOJ have been big buyers of Japanese government bonds, and that has been something they have been wanting to kind of move away from naturally. And a few weeks ago, we saw the BOJ come out and say they're going to moderate their purchases, and markets did not like that. It immediately started selling the ultra long pretty aggressively. But then we had another communication come out that basically said that Japanese government would issue less of the ultra long dated bonds. They were going to front load a lot of that issuance in a similar way to the US did in sort of 2022, which then saw that bull flattener really drive home in the JGB curve. But this is also a function of yields, potentially yields moderating in the US. If we see bigger moves to the upside in the Treasury, especially the longer Treasury bonds, then we'll start to see money flowing back across to the US. But for now, I think a lot of money is heading into Japan.
Yeah, no, I'd agree with that. And the dollar, however, it's probably suffering from this outflow of money, and places such as Japan being not even necessarily a haven, but a better alternative investment has led to the dollar depreciating quite a lot, as we're seeing here.
Yeah, so I mean the DXY broke lower below 99 this morning, was down 0.5 points on the day, and this is similar to before. We've seen yields come down, dollar come down. That's capital flight, but like the Morgan Stanley strategists are now predicting the DXY to fall down 9% to 91 by next year. The euro, yen, Swiss franc are expected to strengthen off the back of this. I think it's a function of risk adjusted returns in the US. The repricing of default risk in the Treasury market is been pretty aggressive over the past year. So even though the Treasuries might be yielding 4.4% on a risk-adjusted basis, that interest rate differential is actually getting narrower, which is seeing dollar weaken and seeing capital fly out of the US. Yeah,
absolutely, and that's of course going to have inevitably impacts on balances of trade as well in the US, etc., which can have knock-on effects on the yields, etc., going forward. So it can be a bit of a cyclical thing, especially if you're starting to worry about, the risk adjusted, including the risk of default. And then just to move on quickly to Brent. So we've been, one of the major headlines in oil throughout the last week is this announcement that the OPEC group are going to be expanding, setting more crude oil onto the market from July. So this was rumored beforehand, and we did see a bit of a reaction on this headline risk, etc., as supply is set to increase. But we still seem to be just entirely stuck within this, quite wide range, but it's stuck within this range.
Yeah. I mean, it's been really interesting because this is now the third consecutive unwind. So it started with 411,000 barrels per day in May, and we've had the same through June and now the same through July. So that's a lot of additional barrels. But what's quite important to consider here, I think, is that OPEC were overproducing by quite a long way. In the case of Iraq and the UAE, just those two together, you had about 1 million barrels per day over quota. So I think this is, as we saw with the previous unwinds, this is more of a unwind on paper, trying to bring that quota up to current production, as opposed to actually increasing production. A lot of these countries are already at max. Like Iraq are kind of, they'll struggle to produce much more than they already are.
Yeah.
And I think this is kind of a response to that. And it's more of like what we saw with Trump, that it's a little bit of the market's got used to it.
Yeah, and ultimately, if people were cheating before, I think changing the policy just to sort of actually not change the output, but to change whether people are adhering or not. Perhaps it speaks to the absolute influence of some of the senior, like Saudi countries within OPEC, and indicates that maybe they don't have the full sway over a lot of the other countries that they ideally would have in order to get them to adhere to the quotas. Yeah. So that's probably being flagged here. But yeah, in reality, I'm not sure that we're going to be seeing too much of an actual change in terms of supply.
Yeah. I mean, the fundamental picture has looked very little changed. And while you do have some kind of intraday volatility, probably headline driven there, that traded range looks pretty comfortable, the kind of $65 level.
And then, just moving on now to a little bit of rumor and gossip about the hedge funds that we've been seeing. So obviously, I think a lot of people looked at Q1, and some of the biggest hedge funds globally seem to have a very tough sort of Q1 start to Q2 with the Independence Day. But some of the big boys are doing a bit better.
Yeah, I mean, when I was at the Commodities Summit in Lausanne, the rumors there were that, Citadel down multi-billions, Millennium about $500 million down in power and gas, Balyasny similar, and now it seems completely the other way. I mean, this does kind of tend to happen every year, and I think it's largely a function of how they allocate risk at the start. At the start of the year, they'll distribute the risk and then aggressively cut back on that and award winning positions and pile into those, and then you do get this huge bounce back in Q2. But yeah, power and gas was definitely a tough period in Q1 for a lot of funds out there.
Yeah, and I guess also, it's no surprise to anyone that Citadel, they can swing it around, and they'd had an incredibly successful power and gas desk over the past, especially since 2022. Yeah. So if you sort of think about it from the economics of that sort of standpoint, they have capital to allocate. Yeah. In theory, they could rely on previous year's successes to sort of somewhat fund, even if they were to have a bad year overall. Yeah. But it seems as though they're running their winners quite well, and so they seem to have flipped a bit, which is good. On the other hand, you have sort of some of the losers in the market, like Anjuran Capital. They seem to be struggling across asset classes, but in particular, I believe they've parted ways with one of the senior power and gas traders recently. As of May. So yeah, it's definitely, it's not simply the case that we're back to old market conditions and, all of these hedge funds are long S&P or long power and gas, and that's a simple, easy ride. It's definitely not the case. And there are winners and there are losers. But yeah, it's I suppose good for maybe global market conditions to have some of these guys winning, but not necessarily fun to see the same guys winning over and over again. But yeah, of course, if you want to learn anything about how to run your winners and cut your losers, etc., James Brodie, he does regular training at the Onyx Institute. So if you follow the link here, you can start to understand some of how he gets involved in sort of trader psyche, etc. Now, moving on to one of the sort of, we referenced new home sales in the US earlier having a bit of an issue on Friday's data, and we're seeing US home supply rising. It's now at the highest level since May 2020.
Yeah, and I mean, it's not massively surprising. The higher for longer policy at the Fed combined with that kind of aggressive rise in 10-year yields have been keeping mortgage rates pretty elevated. The average interest rate for a 30-year fixed rate mortgage in the week ending the 23rd of May was 6.98%. So that was the highest rate in 4 months. So that's going to have an element of demand destruction associated with it. Combine that with the, I think, broader uncertainty, even though we have seen an improvement in consumer confidence. The housing market's sticky. It's a big purchase. It's something you would probably be reluctant to go out and buy if there was any sort of uncertainty. So I think, it makes sense. Just waiting on actual house prices to correct lower, because that's not happened just yet.
Yeah.
But yeah, this is a clear bearish signal in the property market.
I guess the two things to consider here are how are credit conditions, and as we discussed earlier in the show, we expect credit conditions perhaps to be, getting tighter in the future, high 30-year mortgage rates, etc. And then what it comes down to is if consumer confidence is actually higher, as I'm skeptical that it may not be in some senses, is that consumer confidence that has supposedly been high, is that a short-term consumer confidence or is that long-term consumer confidence? Because people are quite often happy, say the S&P's been performing and they can look at their, X number of thousands of dollars that's increased 10%. They might be happy to go and purchase a new white good, or whether it be washing machine or something even more extravagant like an electric car. But housing is even more of an investment. So if they're not confident in their job going forward, and that sort of 30-year consumer confidence meeting 30-year fixed rate mortgages, then I think you will see this dislocation
for sure. And let's say rates do go up. There's only so far that the Treasury yield can advance before that kind of trade-off, that risk-reward trade-off between stocks and bonds is too narrow, and people will start selling their stock holdings and just buying the Treasury instead. And
of course, it's been resale that's been the largest buyer of equities recently. So if you were to see the bond equity sort of trade-off being too narrow, if you would see a lot of capital flight out of equities, it could really spark a bit of a dramatic flip in that diff.
Yeah, for sure. And then what's another quite interesting sort of characteristic of housing markets is how slow they are to adjust in, especially downwards on the interest rates. I mean, Treasury yields have been really volatile recently, but the kind of the 30-year fixed rate mortgage rate hasn't really benefited from downside moves to the same extent as they've been pushed up higher by the Treasury yields. And this is something that's happened before. This is not new. At the onset of COVID, sort of within 2 months after the initial shock, the 10-year yield had dropped by 1%. But it took mortgage rates about 5 months to drop by the same amount. The spread between the 10-year Treasury and the Freddie Mac 30-year fix went from 188 bips to 282 bips. So really blew out almost immediately and took over 8 months to recover to pre-COVID levels. And then when inflation hit and the hiking began, mortgage rates then adjusted much more rapidly. So, they're going to move up much faster than they move down, which makes sense. But we're likely to see a prolonged period of elevated mortgage rates, even if we do see downside moves to the 10-year Treasury.
Oh. Yeah, very good analysis. And then looking just now as well at Chinese PMIs, we're seeing that separately, PMIs in China still not looking too fantastic. So we got a second consecutive month of contractionary data.
Yeah, so I mean, the chart we've got on the screen at the moment is the City Economic Surprise Index in China, and it's quite interesting because China's economic outlook really continues to bifurcate at the moment, as in we're getting some quite supportive, quite positive data prints, and then we're getting some quite disappointing prints. The manufacturing PMIs have remained in contraction at 49.5. But new home prices rose 0.3% in May, and that represents a 2.56% yearly increase. But second-hand properties fell by 0.7%, totaling 7.24%. It's a very murky picture, and I think that's really a reflection of the huge stimulus that's been really quite targeted. So you've seen certain areas of the economy really start to perform, like certain sectors of the property market. But then on the other hand, we still have that overwhelming overcapacity in manufacturing, which is weighing on the outlook there.
Yeah, it's going to be very interesting to see what happens going forward. And of course, I think one thing that we've been fixating on a bit on the show is obviously the EV market in China. But the market as a whole, manufacturing isn't exclusively doing well, and even in the EV market, if you were to measure sort of performance, when you're seeing huge government intervention in order to cut costs of electric vehicles relentlessly, you're going to be seeing that sort of pass through into a lower metric on PMIs, etc. So even the areas that they have a comparative advantage in aren't necessarily going to be huge disproportionate revenue generators in the short term. In the long term, they could maintain a comparative advantage, as they have done in many plastics manufacturing, etc. over the years. But no, it's a very mixed picture, as you say. And then, just to sort of round up the show a bit, let's look at some of the OIS pricing for the next 12 months. Obviously, we discussed, potentially 2 cuts in the Fed. So we've got 84 bips of cuts projected for the next 12 months in the Fed. In Europe and Bank of England, both the ECB and Bank of England are slightly smaller. So we have 57 and 51 bips of cuts predicted there.
We have New Zealand down at 20 bips of cuts, so not quite a full cut there by year end, but by the next 12 months, sorry. The Reserve Bank of Australia down at 88 bips of cuts in 12 months. Canada down at 40 bips, and the Bank of Japan at plus 18 bips. So gearing up for a full hike in Japan, but not quite there yet.
Yeah, and I guess the point of this, Japan's been quite steady with expectations here around sort of plus 10 handle moves.
Yeah.
But the capital flight sort of scenario, especially as the Fed and the BOJ sort of diverge more and more, and in fact the interest rates might, you might see more and more capital going into Japan and into the long-term yields there compared to America. And then in terms of key data releases for the week coming up ahead, so we have a few things. On Tuesday, we have China's manufacturing PMI, the Caixin manufacturing PMI. We have inflation and we have JOLTS data as well coming out on Tuesday. And then, Wednesday, we have Australian GDP, we have Euro area PMIs, MBA Mortgage Applications, and the interest rate decision by the BOC, and ISM Services PMI as well.
On Thursday, we'll have Caixin Services PMIs, the European HCOB Construction PMIs, as well as the ECB interest rate decision and US trade. And then we'll wrap up the week with US non-farm payrolls, European retail sales, and the Bank of India interest rate decision. I think obviously the key one there will be the payrolls on Friday. That'll be the real focus for markets this week.
Agreed. But yeah, I mean, there's always going to be, potential new headline risk as the week unfolds. And, especially with Trump at the helm, you'll be seeing toing and froing, I'm sure, regarding what the tariff situation is come next Monday. But in the meantime, thank you very much for joining us and hopefully speak to you next week. Thank you
very much.